Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planner, CFP Tim Stearns, president and founder of TJ Stearns Inc. Tim, welcome back in.
Peter, thanks for having me.
Always a pleasure. We appreciate the time, the guidance, the perspective that you provide to Chicagoland area savers and investors. Tim, those carefully planning and taking their financial future seriously, they don't want to make any mistakes. They need good information. But we've talked about this on the program before. The plan is only as good as the assumptions that it's based upon. And
absolutely,
for a large part, we've got to question those assumptions and determine if we feel they are reliable and realistic. And unfortunately, Tim, a lot of the status quo and the conventional, traditional approaches to planning for retirement are using some what we could term as financial myths or misconceptions or outdated conventions on what planning should be about and what we should be basing our plan upon.
I agree. And I brought with me today the 7 financial myths, common planning mistakes and misconceptions that we need to reconsider, especially with what just happened in March. So if you don't mind, I'm going to just launch into them because I think we got a lot to cover.
Let's do it. But let me first remind the listeners and the viewers here on Protect and Grow Chicagoland Retirement, now available online on YouTube. You can find the video versions of the podcast there. You can go to TJ Stearns Inc. TJStearns.com is the website, TJStearns.com. And you can find the archives of previous programs. Also available are the resources that we talk about on the program. This week, the 7 Financial Myths Report. If you would like that, pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. So, Tim, let's dive in. Where are savers and investors maybe making some mistakes in counting and relying on some assumptions that may or may not hold true and therefore dictating their outcome?
Well, Peter, in 2008, people were very scared, right? And then we have this 11-year bull market. And I was with some people that I really kind of mentored me. And they said, stock markets die on euphoria. And what did we see? Everyone, it's just going to keep going up through the election, et cetera. And then we had a precipitous fall. So one of the myths that I have that I want to talk about is that the market always goes up. It does go up about 70% of the time. The problem is, what if you retire into a flat market, like what we call the lost decade? 2000 through 2010 was flat. It started here. It did a lot of dancing, went down, went up, went down, and then ended there. So you didn't make any money, and you pretty much maybe lost money because of inflation. So we tell people you need to look at the fact that sometimes the market's not going to go up, and if your first 10 years of your retirement is a flat market or, God forbid, a down market, then what? There goes that theory, so the markets don't always go up, and we shouldn't be euphoric all the time thinking that they're going to.
Well, Tim, I guess this is cutting hairs a little bit here, but I sort of feel like there's 2 phraseologies, 2 ways of saying this, and really neither one holds true. And that's the important factor that we need to examine in how our plans are laid out. But the market always goes up, or the market has gone up over time. And yes, it has gone up over time, but we don't need it to go up over 110-year history.
Right.
We need it to go up in the time that we count and depend on as we are planning for and transitioning into retirement. So A, the market does not always go up. We know that
Right.
with absolute certainty. B, while the market has gone up over time, that doesn't matter to us as individuals in our planning if it doesn't go up during the time that we need it to. And here's the problem, Tim, is that most planning projections assume that the market is always going to go up. If we look at the vast majority of retirement illustrations and projections, they are based on some assumption that the market is going to continually, steadily, dependably rise year after year, year over year, decade after decade. And in reality, if we have a couple years of down markets, like we've seen several times, Tim, that throws off the entirety of the projection and it jeopardizes the outcome that we thought we were going to achieve.
Right. We talk to people about that. You know, it's not, when I see these, I'll call them illustrations or projections that these other, they'll bring in from the other advisor, where they talk about in our retirement classes, you know, at the colleges in the area. And they're always, you know, they're assuming, you know, 8% over the year. It's not always going to be that way. So I'll say to them, you ever had a down year at your job, your marriage, you know, when you played a sport, maybe, you know, a down year? Pros have bad years, right? So my point is it's not always going to be static like that. And I, you know, I'd love for it to be, you know, and make our jobs a lot easier, but that's not a thing.
Well, Tim, it kind of leads right into the next financial myth here, which is the average 10% market rate of return. And there's several institutions that study investor behavior and investor returns, and they say, regardless of what the market has averaged over history, and it's somewhere a little north of 9% over the course of time, but regardless of the market, the average investor achieves nowhere near that kind of rate of return dependably. And the Dalbar study has studied investor returns and behaviors for the last 25 years and has shown this every year, that investors do not get the average return of the market.
I 100%. Because they mostly, most investors will mistime the market. They get in the wrong time, they get out at the wrong time. So, you know, the 10% average market return, when I first started in the business over 24 years ago, that was something that we looked at, you know, that was that's the rule of thumb. And now, you know, we don't use that at all. You know, you can't, you know, especially nowadays with having these markets so volatile. You know, and you know, they climb, and then what if, you know, March happens again, like we talked about? So I don't like the 10% average market return. I think that's way too high. I always tell people, you don't want me to be, when I'm doing your income allocation, written retirement plan, you don't want me to be aggressive that we're making this much money. We'll actually use around 4 to 5%, depending on which one they want. I will not go above 5.
Well, Tim, here's the thing. When making assumptions in your plan, you have to identify, where is there anything that's less than certain? And then what assumption am I making? And then what happens if this assumption is not correct and does not hold true? So if we're assuming a 10% average rate of return into the financial future and we only make 4 or 5, then we are worse off than we expected. Whereas if you're assuming, Tim, a conservative 4 or 5% rate of return, and you actually achieve 8 or 9 or 10, then you're better off than you expected. And that's the kind of planning I think that most people desire. That's what they are looking for. It's just not the type of planning that most people have.
Right. Well, I mean, most of them are still using, you know, asset allocation, which, you know, it's failed us how many times? We always talk about this: 2000, 2001, 2002, 2008. And in March, holy cow, did it, you know? So these are not the things that you need to be doing with, you know, asset allocation was based on, you know, something called modern portfolio theory from 1954. And nothing is modern about something in 1954 compared to the technology and that type of stuff that we have today. We need to be smarter as investors, and people just don't get it.
Modern portfolio theory is past traditional retirement age. And, and Tim, even if the market does average 10% rate of return, that does not mean that we actually achieve a 10% return. And you've got some math here. I know math translates poorly over the radio, but we'll keep it real simple. If we had a 3-year period where our returns were 60%, negative 50%, 20%. So 60 minus 50 is 10, plus 20 is 30, divided by 3. That's an average 10% rate of return over that 3-year period. But if we invest $100,000, Tim, the first year, 60% return, it turns to 160. The second year, we lose 50%, it turns to 80. The third year, we get a 20% return, it turns to $96,000.
That's totally correct.
So, okay, we have a 10% average rate of return. That's what the history of this theoretical mutual fund is advertising, that our 3-year track record is a average 10% rate of return. But if somebody had actually been invested with a 10% rate of return stated and advertised, they actually have less money than they started with, and they weren't even taking any withdrawals.
That's correct. And that's, you know, they a lot of these, you know, when you look at an average on a Morningstar report or what have you, the average isn't really the truth. It's just not. It's funny numbers. And that's one of the things, you know, when we teach our classes, we literally have a slide on what you just said, and we go through it with people, and they go, "Oh, yeah, that's not an average of 10%. You know, I'm actually down."
No,
you know?
I have less money in my account than I started.
Right.
Tim, losses count more than gains. And again, a lot of planning projections for retirement, especially for forecasting our future financial condition, they are based on some expected average rate of return, but averages happen randomly. They do not happen consistently. They are not dependable numbers that are going to occur every single year like clockwork. And that's what we need to realize, is that if we're reliant on an average to occur consistently and then it doesn't, Tim, that puts us off of our financial projection. And these are the kind of assumptions that you need to carefully review your plan to make sure that you have identified. And the trained eye of a qualified professional, a certified financial planner like Tim Stearns, can help you spot and identify if your plan and your financial future are based on any of these myths or mistakes or misconceptions. If you'd like to sit down with Tim, if you'd like to get a thorough forensic financial analysis and retirement planning strategy session, pick up the phone and give a call. 800-640-2256. That's 800-640-2256. Tim, again, kind of cascading here, and all of these things seem to be connected, but the amount of cash flow, the amount of income that our portfolios should be able to generate really has been called into question. Most forecasting, most financial models that project out into the future are based on a theory that at least is outdated, is certainly questionable. We really need to examine it.
Right, and that's in the book. It was based on a gentleman he was a certified financial planner out in, I believe, California, but he came up with this 4% rule. So he said that if you had $1 million portfolio and you pulled out 4% a year, you would be okay and not run out of money. He does not even use that theory anymore, because what was happening in the 90s when he came out with that is it was a nice, good run in the bull market.
Right. That's
with some stocks,
the best historical bull market run in history. And Tim, we could go to a bank in the early 90s and get a 2 or 3 year CD paying 10%.
Right.
Made taking 4% cash flow pretty easy.
Right. Exactly.
Not the world we live in today.
Right. And what they found is that fails over, 40% of the time. So one of the things we say to people in our class, if you get on an airplane and the pilot comes over and says, we have a 40% chance we're going to make it, or excuse me, not make it, do you stay on the plane? And everyone shakes their heads. Well, a lot of people are doing that with their financial planning. And so if they don't have a written income plan, I urge them to do it. When we do it, we allow about 2% pullout. And this is according to, many experts, that it won't fail. For Dr. Wayne Pfau, I've seen him speak, and he goes through it. I mean, he recommends, around a 2% withdrawal rate, and you'll be safe. So
he's a PhD who studies retirement. He's
that's all he does.
the American College of Retirement Income
Right.
Planning
Right.
division, and he's dubbed the retirement researcher, has said
Correct.
this. But
Right.
again, Tim, this 4% cash flow, it is the standard. It is the go-to. Most retirement projections and illustrations are actually based on this concept, even though times have certainly changed. The world around us has changed. The market environment has changed. The interest rate environment has changed. Still using outdated kind of thinking and theories to project out retirement. And again, if this does not hold true, it impacts your financial future. Now, that being said, Tim, there are ways to generate more stable, consistent income, and in some cases, even higher income than this theory would indicate, but it's not using the financial model that this theory was based upon and that most people's plans are based upon.
Right. It was using stocks and bonds, better known as asset allocation. And we've said enough about that it doesn't work. So this does, there are other plans that you can use, like an annuity, that it gets a much better payout, than using that. And it's safe. It's guaranteed. The thing I couldn't handle if I was retired is that 15 years from now, the premise that I went on was completely wrong. What am I doing then? I was 65 when I retired. Now I'm 80. I'm going to go back to work. We always kid that, Walmart won't even hire you. It gets a laugh, but it's an 80-year-old working. I mean, that's, you have to be ready for a 30-year retirement. We always tell our clients that. We always tell our classes that. And that's the truth. People are living longer and longer and longer. And let's say the husband passes. Well, the wife, usually outlives him. So we have to plan for that 30-year retirement. And, like I said, I want to make sure that I can sustain it.
Once again, we are talking with certified financial planner Tim Stearns, Chicagoland area savers and investors resource for important information, common sense guidance and perspective on planning for your financial future. If you want to examine your plan to see if your financial future is reliant on any of these financial myths, misconceptions, or mistakes, these assumptions that we need to carefully identify and question, pick up the phone, give Tim Stearns a call. He'll run that forensic financial analysis, and he'll help you pinpoint and spot and identify red flags in your plan, holes that have been left unaddressed, the assumptions that are being made in your plan, areas where you can be more strategic, and he can help to structure and implement that plan for retirement along with you, or even just provide you this list that you can go over on your own time of the 7 financial myths. For either of those, pick up the phone, give a call now, 800-640-2256. That's 800-640-2256, 800-640-2256. Or you can go online, tjstearns.com. The podcast archives are located there. Reports, resources, tools, calculators are online at tjstearns.com. Make sure you like and subscribe and share those editions of the podcasts. They are topical. They are relevant to specific issues. And if you know somebody, if you have an issue yourself, or one of your friends, neighbors, coworkers, loved ones, family is having questions about a specific financial issue, there's more than likely an episode of Protect and Grow Chicagoland Retirement that deals with that issue right there on the website, tjstearns.com. You can go and share those there. Or again, for this list, just one of many resources that Tim has recently offered here on the program, the 7 financial myths. Give a call, 800-640-2256, 800-640-2256. Tim, this is a big one. In fact, a generation has really planned based on this premise. And now we're seeing that it may or may not hold true. The idea, the financial myth, the assumption that taxes will be lower in retirement.
Right. And I run into this all the time. People say, oh, we're living on $100,000 a year right now. And we won't need that when he's retired. That's not going to work.
Another one, we assume that we're going to need less income in retirement. Every day's a Saturday on vacation. I don't think that I'm spending less on my weekends or on vacation. That's when I spend my money.
Right. And so we always tell them, well, why don't we sit down and we'll do a budget, And so we sit down and do a budget because we're going to do an income allocation, and the light goes on that, oh my Lord, I'm going to be spending about that to maybe even a little bit more because we're going to do that trip we never got to do. I want to buy that car. The kids are out of college. They're self-sufficient. I can finally buy that really nice car I wanted, or that nice house second house somewhere. It all the above is the reasons that I tell people your taxes won't be lower in retirement. And taxes are all time low right now. I mean, I ask in our classes to a person, every person says, "Oh, they're going up." So the premise of planning your retirement, the taxes will be lower in retirement, is a fallacy. And it's a myth. And you don't want to plan on that. You want to plan on, I tell people, whatever you're in right now, I'd stay the course, because you're not going to, what are you going to stop, belonging to the golf club? You're going to stop, going to the spring training trips that you want to do, or spring break trips. So these are things that we go over with people, and I hate to say it, but we put some cold water on their plan and say, we got to be realistic here.
Well, here's how to know if your plan and your financial future has been based on this assumption, or if you have made this assumption in your planning. Do you have any tax deferred dollars? If you've got 401ks or IRAs or 403bs with tax deferred dollars, you did so under the assumption that it was going to be easier to pay that bill out of your nest egg in retirement than it was out of your paycheck while you were earning new income. And the reason why we were taught and trained and pushed to do that was the assumption that taxes would be lower in retirement. But nowhere is that written in stone. Nowhere is that written in the tax code. We are in a historically low tax environment right now. So Tim, I know you do a lot of proactive work with those savers and investors who have already built up a large tax deferred balance in their accounts, to go ahead and make sure they're being as strategic as possible and leveraging those dollars, keeping as many of them as possible.
Well, one of the reasons that we're doing that is people, taxes are at all-time low. So why not maybe look at some Roth conversions? I usually try to do it after they've stopped working, just because, the taxes are considerable, because anything that you do with a Roth conversion goes to your bottom line, and, the government looks at all as income. So, and then one other thing a lot of people aren't catching on to, unless they're gone on it, is that Medicare is doing means-based. So you can be a saver and have, a couple $1 million of money, and then you go to get your Medicare and your bill is, $400 a month for just you, and your wife's another $400. And some guy who only saved $20,000, he's living off his Social Security. Any money he's pulling out is not much. His bill is about $100 for Medicare. The government is doing means testing. So people need to be cognizant of things that have completely changed. And, that's a new thing. When Social Security came out, it was never going to be taxed. They weren't going to use it as our identification number. All the above has happened. So we make sure with our clients that everything we do for them planning wise is dynamic, because the government's going to change rules like they did with the Secure Act. The CARE Act has changed some things. We stay up on all that, and we make sure that we're understanding what taxes are, what your true tax bill is.
Well, again, your outcome is determined by the assumptions that are made in your planning, and the plan is only as good as the assumptions that are made and whether they are dependable, whether they hold true. So one of the steps in the planning process along the way is to continue to examine that plan, to poke holes in it, to identify those assumptions, and to discuss and consider whether they are reliable, whether you are comfortable depending on the assumptions that are being made. And in my planning, I'd rather make the bad things happen on paper. I'd rather kind of look at the plan as though Murphy's Law was indeed a reality and a law that the bad things will happen. Let's make those happen on paper so we are prepared for them in real life. If your assumption is blue skies and rose-colored glasses, and that does not hold true, you are in a worse financial situation. If we assume that taxes will be lower in retirement, and then they are not, they just stay the same or go up, we have less money than we anticipated. If we assume, on the other hand, that taxes will go up, and then we're wrong about that assumption, we are in a better financial situation than anticipated. That's the side of the assumption that I would rather be on. And Tim, I know that that is the approach that you take there at TJ Stearns, Inc. and in the planning that you do for your clients in Chicagoland area savers and investors. And again, ladies and gentlemen, if you'd like this complete list, we made it through 4 of the 7 on today's program. Maybe time to just touch on the final one to wrap up the show today. But if you'd like the complete list, give Tim a call. If you'd like to review your plan, give TJ Stearns Inc. a call. He is your certified financial planner. There's no downside for placing that call, no cost, no obligation. Of course, never any benefit from procrastinating. No need to meet in person to get this process started, we can do a Zoom. You can do it virtually through the convenience and safety of technology. 800-640-2256, a good old-fashioned phone call for any of that and to get that started. 800-640-2256. And Tim, just going to wrap up here with the last one on this list. I like this one. The misconception that it's too late to plan or I don't have enough.
I've had that happen many times. I had one client who I've had her sister and brother-in-law as clients for forever. And they kept saying, she's got to come see you. She's got to come see you. And she wouldn't. And finally she did. And I said, excuse me, what was the impetus that made you finally come? And she said, I was afraid you were going to tell me I had to keep working. I didn't think I had enough. Well, here's the good news. With an income allocation plan, usually we can do more with less. An asset allocation plan, it's hard to do that. If someone hasn't been a saver and they think it's too late, I disagree. It's never too late to do some planning, even if you're retired, just to maybe move some things around to something that's safer after what just happened in the markets, so those are the things that I've had people say that a million times, and we that's a misconception. We can totally help them.
Well, again, never too late. There is not an account minimum. Tim Stearns, a certified financial planner, willing to help anyone who is serious about planning for your financial future. Always a way that you can help, always a way that you can improve your outlook, ladies and gentlemen. Pick up the phone and give a call, 800-640-2256. I would add to this one, Tim, that there's a myth or a misconception that once I've done the planning is done. We need to continue to update that plan on an ongoing basis. Your life is going to change. The world around us obviously changes dramatically and very quickly. Let's keep that plan up to date, ladies and gentlemen, and review it for the assumptions that we may have made 5 or 10 years ago. Tim, I know you do that for savers and investors across Chicagoland each and every day.
100%.
Pick up the phone, ladies and gentlemen. Tim Stearns, a certified financial planner, a CFP, willing to donate his time if you are serious about your financial future and willing to invest a little of yours. It's a great investment in your financial future. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. Visit online, tjstearns.com, tjstearns.com. Be sure you like, subscribe, and share the podcast. We always appreciate you tuning in here on Chicagoland Retirement, Protect and Grow. And Tim, we appreciate your guidance and perspective.
No problem, Peter. Thank you for having me. It's been a pleasure.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.